All right, everyone. It is 6:03 at the moment. At 6:05 exactly, we are going to go ahead and begin. All right, everyone. It is 6:05. Let us go ahead and begin. MD, if you don't mind, please share your screen. Today's or today's webinar is going to be basically on how to analyze investments. We're going to get into the specifics of how we're sourcing investment deals, what we look at when we're analyzing them, how we calculate ROIs. And, I appreciate, again, all of you guys joining on the weekend. MD is our acquisition manager. So he's pretty much the person who first gets a look at the deals. So I'm going to let MD go ahead and take over and, give us some golden information.
Hey, welcome everyone. Wanted to thank you for stopping by, taking your time. Today will be essentially our last webinar session, but we saved the last for the best. So we saved the best for the last, actually, I would say. So today we will get into the specifics. It's an overview of how our investment strategy flows, how we identify properties and manage them, and make it a successful real estate investing strategy in Metro Detroit. This is important if you're investing in a fund. Even if you're not investing in a fund and you're just thinking about investing in real estate in our market, it's very crucial information to have. So yeah, just if you want to take some notes, feel free.
MD, if you can reshare your screen.
Oh, you can't see my screen?
No,
Oh, I apologize.
no worries. And then, of course, this call is being recorded as well. So we'll make sure to send it out to everyone. That way you guys can review later. It'll also be put on our website.
Okay. So just to confirm, can you see my screen now?
We can see your screen.
Okay. Okay. Here's our intro page. Obviously going over our strategy. So let's get into it. This is where we find our deals. We will look over the MLS, which is the multiple listing service. We're able to find properties on market, as well as we will look at off-market listings. And we have a cold calling team that is dedicated to make certain calls. We have a list of expireds and whatnot. So they have a whole side that, that they can explain. But, we get from MLS, from cold calling. We also deal with wholesalers. A lot of wholesalers in this area are getting good and lucrative deals where we can potentially make money on them. Most of them are distressed properties, which is why we're able to find these lucrative properties, as well as we attend property auctions when time is available. We're able to, schedule out and attend these and see if there's any good properties that we can bid on. Continuing forward, this is essentially how we're able to secure a good deal. We look at the scope of work. When we first initially go and look at the property, we will take our contractors in. We look at how much work it needs, the severity of the work. We look at time frame, and we look at cost. Related to cost, we also use that scope of work to calculate ROI. We have a whole ROI calculator that I will show here. Here is an example of our ROI calculator. This is just Nabil, I don't know if I remember, but are these projected numbers or these are just made up numbers?
These are pretty much numbers from real deals. This was just a sample number that I put together. If you want to kind of go over it, or I can go over it, whatever is easier.
Yeah, if you want to explain, because I don't think I ran these numbers, but if you want to explain and make sure why these numbers there are the way they are.
Absolutely. So the first thing is that before we input any information into an equation, we have to know what are the factors that we need to know to plug into the formula, right? Number one is the acquisition cost. This is consisted of your actual purchase price plus closing cost, and then your rehab estimate. Of course, those of you who have invested, those of you who are thinking about investing, just know that you can get very accurate, but your rehab cost might not be exact. Still, you want a baseline to be able to get your estimation and your ROI generated properly. And then the two most important things is, what can I sell that property for, and what can I rent that property for? For our team, being that we have access to the MLS, we are a real estate company. What our business kind of is on a day-to-day basis is coming out and determining those evaluations. For investors, if you can't, get access to that information yourself, I would definitely and highly recommend that you work with a investor-friendly realtor, someone who understands the market, someone who understands and can estimate based on a projected rehab, as well as determine the rental cost. So again, three very important factors: purchase price, what I'm buying it for, what it's going to cost me to get it up to market standard to either rent or sell, and then how much can I rent or sell for. So this ROI here basically highlights not only rentals, but flips. On the bottom, you'll see two different tabs. And we'll start with, I guess, the rental one,
Okay.
just to kind of begin. Rentals, there's oftentimes people who are also buying with mortgage. This training session, this information is going to be focused towards cash investments. If you guys want this, ROI or Excel calculator, do let us know. We will provide it to you guys, for free, no problem. But on the right, the second column, column C, you'll see that it does have, a way to calculate the mortgage costs and the cash flow if it's a mortgage deal. Again, we're going to focus our training on the cash. So, as an example, and these are very consistent with the type of deals that we do as real estate brokers representing investors, as well as what we intend to do with the Fajr Fund. As an example, this is like C-class properties mainly in the city of Detroit, that are a little bit higher risk, but with our strategy, our investment, we make not only equity but extremely high ROI when it comes to the rentals. And again, keep in mind that this is all cash on cash. So you have a protection against leveraging, overhead and things like that. So this strategy really works out well for what we're trying to accomplish. But to each their own, there are many different strategies that investors use, and depending on what you like, feel free. But really, reality is that this is a way to calculate. Doesn't matter your strategy. So we put cost, right? as $40,000. Being that you're buying it with cash, quote unquote, your down payment is actually $40,000. The closing cost, what we generally do, if you can click on that tab there, you guys will see up top, we do the purchase price times 2%. Okay. Sometimes, especially in low budgets like this, the closing cost goes a little bit higher. So, what I'm going to have you do, MD, is change that to 3%. Okay. And the reason we're changing it to 3% is that usually the rule of thumb is 2%, but when you're at investment prices and purchase costs of this range, you still have very basic costs like settlement fees and transaction fees that even though the cost is a lot smaller, those fees don't necessarily change. And it might make your smaller and lower end purchases, closing costs go up to as high as 3%. But, when you're thinking about, 100,000 plus, your closing cost generally is about 2%. We've estimated that on this property, we're going to do about $30,000 in repairs at a rent of $1,400 a month. With you guys also having ongoing expense, we need to factor that in. All right. Number one is tax and insurance. If you buy cash, insurance is not required, but highly recommended because things can go wrong. Oftentimes when you're investing, sometimes there's, natural damages and issues that can happen. Then there's unnatural things like break-ins or, whatever the case is, God forbid a fire. Insurance is there to protect you guys. And what the cost of insurance is versus the peace of mind it gives versus the safety net, it is always recommended. So we've inputted a number, $1,000. This is usually going to be the cost for that property once it's actually rented and cash flowing. When it's vacant, probably in that construction period, because it is vacant, they may charge a little bit more, but overall it is going to be right around 1,000 to 1,500 a month for price points at this range, just depending on what insurance company you guys are using. Now, we've calculated for tax and insurance, but in real estate or in all investing, you also want to have additional buffers when things go wrong, when things don't go according to plan. And just generally, when you're thinking, hey, I'm scaling, you want to leave that room. So what we do as a rule of thumb when calculating deals is we factor in 5% for maintenance. Okay. So whatever the rent is, we're roughly calculating 5%, another 5% for vacancy. And then we're also factoring in the 10% for management. Okay. If you guys invest with the strategy that we're investing, which is buying and fixing ourselves, you can often assume because you're already spending $30,000 in that property, you probably won't have a 5% maintenance cost, but still for now, we're going to go ahead and leave that there. If you decide to manage it yourself, which I highly recommend everyone gets a property manager, someone dedicated and focused on making sure that that investment is successful, that, additional support, it's well worth that 10% cost. But overall, when factoring in 5% for maintenance, 5% for vacancy, another 10% for management, you guys can see on this deal itself, right? We're at a almost 14% ROI. And what I'd like to show you is let's just say we don't have 5% maintenance and vacancy. MD, if you could do us a favor and remove that. Let's just see what the potential maximum is.
And can we explain to them potentially why we can remove the 5% vacancy rate?
Yep. We will definitely do that. Let's adjust both of them, and then I will explain what we plan to do. So, number one, when it comes to vacancy, it's a little bit more of a concern, especially for those who are investing with cash paying tenants. A lot of cash paying tenants, they have a shorter turnaround period, meaning that they often stay at a property for 12 to 24 months. That's a reasonable range to expect a tenant to stay. Versus the strategy of Section 8, it does take a little bit longer to occupy the home with a Section 8 tenant, but the beauty of Section 8 is that being that it is a government-backed voucher, it is the government paying on behalf of the tenant, They also don't want to move around often because there's a lot of verification processes. There's not too many homes that they have options to pick from when it comes to Section 8. The turnaround time is right around 5 to 7 years on average. That means your tenant is likely to stay in that property significantly longer. So, as just an example, assuming we don't need to deduct 5% for maintenance and 5% for vacancy, in a perfect world, you can see that on an investment like this, your ROI can go north of 16%. Just as a comparison, I'd like to mention that, oftentimes people are investing. It doesn't have to be this strategy, but they're investing in real estate for passive income. And especially for commercial investors or people looking to buy turnkey investment properties, sometimes they're getting alternative or conventional financing. They're happy, like commercial buyers are very happy with 4 to 6% oftentimes. People who are buying with financing, 6 to 9%. If they reach 10%, oh my God, that's a steal, right? So I've done investment deals with all sorts of buyers, different types of people, different price points, different appetites. And one of the most lucrative ways, and it doesn't have to be in the Detroit market, doesn't even have to be at these price points we're looking at, but it is to buy, then fix and create equity yourself and then rent it out, right? You're building something for yourself versus buying something that someone else built. And when you do that, automatically there is appreciation, there's sweat equity, right? So all this is really just adding to your bottom line. It's not easy, but it can be done. And if you don't have the experience yourself, get professionals in this industry to guide you, to work with you, to partner with you, right? And when you have good help, things become so much easier. Any questions, guys, on this rental ROI calculation before I move to the flip analysis? All right, let's go ahead and switch screens, MD, to the flip side. Now, on a property, this is an average, something that we usually are comfortable with. And what I'm going to do, MD, after I go through these sample numbers, I'm going to have you go through, let's say, one of the deals we just did, Tepper. All right. Put the acquisition fee, our wholesale cost, everything into the original purchase price. And we're going to run these real numbers to show people what real deals that we're doing. But based off the amount of a $70,000 investment, what we as a company target is for roughly 25% in appreciation, in equity. And the reason we target that number is because if you were to sell, you have 8% roughly in closing costs. When you sell, 25% minus that 8%, you're almost at 20% still. You're at like 17% ROI. And oftentimes, like you'll see here, we put the ARV value of 95K. That's an estimate. The purchase and rehab cost of $70,000. Even for the closing cost here, we put $2,000. And if you can adjust that to $1,200, assuming that it's exactly the same as the other number.
Yeah.
That way we can get the real numbers. Then you'll see we've not only factored in the actual hard costs as well as the selling price, but there's so much more. These are specifics that people often miss, okay, which is the holding cost. Super important. One, if you have a mortgage, of course, factor in that mortgage payment, but property taxes. We've actually, on the previous screen, if you can go back to rental,
Yes.
show them how we've determined that 2592 tax. Click on that future tax link. And even this 2592 tax, we're estimating what the tax cost will be after a new purchase. Oftentimes, when people are investing, they only factor in what the current taxes are. And, although it makes your numbers look better, you don't want to have a situation where, you as an investor are like, oh man, I only calculated $1,000 in taxes because that's what it was when I bought it and it shot up. So, my ROI has drastically changed. So as you can see on this website here, guys, this is by the state of Michigan. Doesn't matter. Every state, every area that you're looking to invest will have something similar to this. But it allows you to put in the county, the city, and the school district, and you can immediately see the millage rates. There's two different types of millage rates, guys. One is homestead. MD, tell us what homestead means.
Homestead means that it's a personal property and that the owner lives in it.
All right. Does that apply to our situations?
Absolutely not.
Absolutely not. All right. So we as investors need to focus on the non-homestead taxes. All right. This is something that is either investment property, it's vacant, it could be a vacation home, anything except the house that you live in as your primary occupant is a non-homestead home. All right. Now, SEV, that is the state equalized value. MD, how is the SEV calculated on new purchases?
For the state equalized value on new purchases, it is cut in half. So the value of the purchase price, you divide it into half, and then you'll get the SEV.
Yep.
So if we go back in here, sorry. So we are looking at the flip, correct?
Sorry, go. We're looking at the purchase price, which is 40,000.
40,000. So we are putting 20,000.
That would be fine for current taxes, but I also like to be even safer, guys.
Yes.
We are doing work to the house. What happens when city employees drive by and they notice that, hey, this home is new? You know what? They've done work to it. What they do is they then report back and say, guys, we've got 123 Main Street. It's been updated. So they're going to kind of go off of what they think the property value is. So what I'm going to do is I'm going to do 50% of the purchase price plus the rehab cost to give us even an extra safety net. So we got 70,000 divided by 2. MD, put 35,000 in that spot there. Let's calculate. Okay. So this is showing a little bit higher than what we estimated. We're going to change that number, all right, to $3,024. This is adding additional cushions of protection. Maybe they won't estimate or they won't analyze the SEV to be that high, but we want to have the worst and best case scenarios before we make a decision. As you guys can see, it slightly adjusted the ROI, but when especially you're investing on certain deals that are 4, 5, 6, maybe 8%, these 0.5% changes are drastic. All right, so let's go back to the flip column now that we've showed them how to calculate the estimated taxes. You'll see we've estimated the ARV to be 95K, the purchase and rehab 70,000, closing costs 1,200. Then we have the taxes again, MD. Let's go ahead and change that monthly cost right there on the right. So what was the taxes?
So the taxes was
3,024 divided by 12. Let me do that for you. Put in 252 there.
252.
All right. So as you can see, this also factors into the ROI. We, as a rule of thumb, say about a 6-month investment cycle, especially when it comes to fix and flips or anything that really requires fixing. And it depends on the length of the fix or the scope of the work, but this gives us more than enough time. Let's say you close on a deal, you start a renovation project. That renovation project, like on a $30,000 rehab, that should take our team roughly about 45 days. Sometimes it's less, sometimes it's more, depending on, your team. But let's round up even higher. Let's add another buffer, right? A buffer of 15 days. We are at 2 months in renovation. Now, once you go on the market, you may be on the market for a month, maybe even 2 months. In a scenario like that, we also have more than likely a buyer who's going to buy with financing. So we need to add an additional buffer of 1 month to 2 months for the mortgage time. In a scenario where it's a rental, it's 2 months to do the rehab, maybe another 2 months to occupy the property with the Section 8 tenant. You're probably in usually around 4 months, but still we'll base our decisions and our estimates off a 6-month analysis. So you guys can see all the holding costs there. Then when you sell, I know I mentioned a little bit earlier, 8% cost. What is that 8%? Well, 6% of that goes directly into paying realtor commissions. All right. Unless you guys are brokers and agents yourself who are hiring yourself, more than likely, most investors often hire a professional company. This 6% is well worth it because what you get is a dedicated agent with resources, relationships, negotiation skills, and someone who's going to do the best they can to market your property. Well, 6% is the going rate. And then we have another 2% in additional closing cost. You guys can see after everything, when you go to line 20, total costs, including purchase, that's factoring in your mortgage payments, if applicable, your holding costs, your purchase, your rehab, your inspection, if applicable, your commissions, closing costs, you name it. And what it's showing here is on an $81,000 total investment cost, we were to invest about $70,000 and hold it for 6 months' time and sell around 95K, you would walk away with a net profit of $13,486. When you look at it at a percentage form, that's 16.5%. And then when you look at it as an annualized ROI, annualized means, hey, if I was to have this investment over a year period, what would my ROI look like? You can see that in 6 month cycles on capital invested, you could possibly be making a 30% plus ROI. And the deal that we're showing here is not even the most lucrative when it comes to flip. We're being pretty reserved, but again, this is to show you what the possibilities here are. Of course, it all looks great on paper, but what makes or breaks deals is who's managing it. What experience level do they have? What resources do they have? So, especially for new investors, I would highly recommend that you guys partner with people. For seasoned investors, as you guys are scaling, it's important that you guys keep implementing new systems and new things in place. All right. So we've showed you guys a sample deal. Now, MD, can you quickly just go over that Tepper deal that we were working on and we just signed? Let's actually input the numbers there.
Yeah, it gives me a good opportunity to segue into our master deal tracker, which, this one, we will put all of our deals that we analyze, that we offer on, that get accepted. And we will share this master deal tracker with our investors. And so you can see what's going on, how many deals are in the pipeline, and exactly what's and you can see the comparables, you can see the pictures. So all this information you will get.
Okay. So
So,
let's go with the Asbury Park deal.
okay,
All right. And then I know we put the offer amount 45,000, put the buffer, the acquisition cost. When you put in the purchase price, put 55,000 to add all fees, wholesale costs, commissions, and then we can put the other details as well.
perfect.
So let's go here.
We have 55,000 for the purchase price.
Yep.
And then what is the renovation cost?
Let me quickly go.
I think Mustaq Bhai said 25,000 if I'm not mistaken, but just to confirm, check.
Let me check. So he actually said it would be $30,000 and a 2 month timeline. So let's put 30,000 plus the 55. So we have about 85K.
Okay.
So put minus in front of the 85. Okay.
Mhm.
Now ARV, all right. You are the master at this, so I'm going to let you tell us and kind of walk us through how you got that ARV too.
Yeah. So let me show you back to the master deal tracker here. If we can go into the comparables. So when I open the comparables, these are very similar properties, all in the same neighborhood, College Park area. They're they're all 2 bedrooms, and the subject property is 2 bedrooms. So we want to make sure that we're very accurate in these data, because 1 bedroom can make a difference in price point. 1 bathroom, even having a basement or a garage, can definitely change the price. So as you can see, these are mostly brick and just a couple vinyl. Our subject property is brick as well, so that helps in getting more value out of the property. And The brick properties are definitely selling for more. This one sold for 140,000. This one listed for 140,000, but eventually sold for 137. This one sold at asking price at 130. This one also at 119 is pending, hasn't currently sold yet, but I'm assuming it'll sell around that same asking price, but because it is definitely updated. So based on this, let's go for the lower number. Let's say 119 is our ARV.
Okay. And we went with the lower number for what reason? Why not say 130?
Because we want to calculate for everything that can go wrong. If we put it on the market, what if it stays for more than a month? Then we're not getting our asking price, or we're least likely to get our asking price. So I want to account for every situation, and like you said, have a buffer room. We should have a buffer on top of our buffer, just to make sure our due diligence is done.
Absolutely. So even though we're putting 119 here, is there a possibility it could sell 125, 130?
To be honest, I think we can sell it like 135. Yeah.
Okay. All right. So we'll go with 119 for the number's sake. All right. Now, this property here, let's assume we invested 85K into it, right? Now we have to adjust the taxes. So let's go back into the property tax estimator.
Okay.
Let's say 42.5. And again, even guys, these taxes, we're really adding additional room for protection when it comes to our estimates. But when you're buying really at, let's say 55K in this situation. This is basically what your taxes will be really based on. But we're also analyzing for worst case, you decide to keep it, whatever it is. But truly, when you buy, taxes don't even get reassessed until the next tax calendar, which is the following year. So again, still, let's go off the number $3,600 divided by 12. Let's say it's $300 a month.
So we will change this to, 1 second, $300 a month.
Yep.
6
Okay.
months.
Utilities, insurance are fine. Now, you guys can see on this deal in itself, our real numbers based on what we are actually buying it for, based on the actual renovation cost that we've got. And this isn't being done actually for the Fajr Fund because Fajr Fund launches August 1st. For those of you guys who have invested, those of you guys who are investing, basically that is the deadline to invest. But again, this is being done and we're continuously doing this for individual clients as well, for some people we have relationships with who have been working with us. But you can see on this deal itself, with us having multiple layers of protection on the rehab, the estimates, the ARV, like MD, you know what? Let's add another 5% to our, 10% to our renovation cost. Let's change 85 to 88. Let's say it goes over budget. All right. So if it goes over budget, still you're at 17%. And the reality is that our contracting team estimated that we should be able to get it done within 25K, but still we're estimating already at 30K because we know things always go on unplanned. We plan for things to go unplanned, right? But this is a real scenario of a real deal that we are doing. These are the numbers. This is what we confidently can get as a return on this investment. All right. So let's go back to the slides unless anyone has any questions about these real deal examples and analysis.
Okay, here's another calculator that I wanted to share really quickly. This is a after repair value calculator, new ARV calculator. So essentially, a lot of the times we are on the road. So, to get a quick glance at the numbers for these properties, we open up this calculator, run the numbers, and we will go over to the property, evaluate the scope of work, and essentially see what it needs. But this here will tell us what percentage we need to stay in. Our general rule of thumb is 70%. We want to have ARV of 70%. If it's anything over, then we are not getting a good investment and going over budget. If it's anything below, then it will definitely be a better investment. So, for example, if we can get our renovation costs lower, and let's say to 21%, our calculator turns green to 65%. And anything below 65% is a great investment. So this is a green light for me. I will go ahead and check the property out and get our scope of work done.
And to give a little bit of more detail on this, guys, why this and also have the spreadsheet? Well, the reality is that spreadsheet gets very specific, and it's best that, especially when you're doing this as a business and you're constantly analyzing deals, that you have a simplified version of doing things. We don't have all the details. Maybe we didn't get the full rehab cost yet, or we don't know the taxes. We don't have all the details in front of us, and we don't want to invest all the time to get into the specifics when we're not even sure if this is a good deal or not. At this point, between me and MD, we've kind of memorized how to do this. And me and MD's working relationship is that he often doesn't even send this to me. He'll tell me, hey, Nabil, based on our calculations, it's 65, 70%. And this is just a quick glance. It doesn't have the specifics. It just has some basic numbers. And I know that, okay, if an investment deal based on the basic numbers is 65% of the ARV, then when I get to the real numbers and I start putting in the holding costs and the commissions to sell and the closing costs and all that good stuff on a 65% of ARV calculation, the investor will actually probably make 20, maybe 25, because we still have those buffers. But the question is, what number gets us to that true net 20, 18, 15, 25, whatever it is that you're targeting? For us, the number is 65%. All right. Let's go ahead.
So yeah, after we calculate our ROI, our team conducts the due diligence. It's the process of, going over to the property, evaluating what type of work it needs, how much it needs, a timeline of how long it will take to finish, and we will essentially put it together and put a package together in our master deal tracker, which leads us into our next slide, is the red flags that we take. So we have a checklist when we do our due diligence. First and foremost, the most important thing is location, of course. We look at each and every neighborhood. In Metro Detroit, each neighborhood is different. For example, you could be in Warren and values change 6 figures. For example, North Warren, I live in my personal property here in North Warren, and our values in our subdivision are right around the mid 500s, which is, I would say, a lot for Warren. But alhamdulillah, I think our community has brought up that value. And if you look in South Warren, it is growing, but it's not nowhere near 500,000. It can range from anywhere to 120,000 to 180,000, and that's ranging from 8 Mile to 9 Mile. That's considered South Warren. Now, if you look in Detroit, you have to be more specific. Detroit, we have to look at each and every single block, because you can look at a certain neighborhood and that might look good and all, but some blocks are vacant. Some blocks have, just empty lots or abandoned properties. And compared to the next block over, it could be all occupied properties. So we want to make sure that we look at the street view and make sure these are good blocks where there is no vacant land, there are no abandoned homes on the block, that everybody takes care of their house, that the lawn is good, that the conditions of the neighboring property, they're good condition. So that's the yes.
Yep. And I just wanted to add something here too, especially when it's like neighborhoods, like South Warren or even Detroit. What's next to you is so important. This is something I learned through investing. You could read all the books in the world you want, but unless you start doing it, you will not be able to tell how much a vacant property next door makes a difference for a first time home buyer or a family that's thinking about buying it. That potential vacant home could be, used for homeless people. It could be squatter occupied. I mean, not to scare you guys, but some of these homes might have drug addicts in them, right? Or whatever the case is. So people, even though on paper the numbers look so good for this street, that one property, the numbers that you estimated, basically, in short, might be all wrong if the property next door is completely vacant. So these are also very specific factors that we look into. And then we do have a question because I'm talking, I'm just going to read it. Can Fajr Fund buy a block and revitalize it? Conceptually, absolutely. If we fortunately connect with the city and they own, all the vacant properties on that street, or we happen to connect directly with multiple sellers for all the vacant properties on that street, then absolutely yes. When we usually invest, the best strategy is to invest in what I like to call clusters. If you're investing in this area, you want multiple people investing in different homes that are being bought, because every property that's purchased, rehabbed, sold, rented is all adding to the value of every other property. So in an ideal world, yes, we will buy, even if it's not the whole block, multiple properties on a block. And that makes a major difference on your values. All right, let's get into some of the other stuff, MD.
Yeah, continuing on, another major red flag is foundation issues. We look at the structure in itself after the neighborhood is all good dealt with. We look at foundation issues, if there's any water leaking, if there's any cracks in the basement, any settlement, if the pillars and beams are all discombobulated and not in place, then that's a major red flag. So these are major because when you get into a property and if it has settlement issues and foundation issues, it's one, very hard to flip, and second, when tenants see these issues and it's ongoing, and foundation issues usually lead to flooding issues as well. They tend to have a lot of vacancy rates and turnaround rates, and it's just not good for the investors. We tend to get stuck if you have these problems.
And it's not that it's not solvable. The
Yeah,
problem usually is that foundation issues is hard to pinpoint the exact solution.
yeah,
So it could be as simple as something like doing additional grading on the exterior of the perimeter of the home. What that means is adding additional soil, concrete, whatever around the base so that water doesn't seep in. Or it could be something as, difficult as digging out the whole perimeter, anchoring the foundation, putting some, waterproofing material, French drain systems, then, putting all that dirt back and then compacting it, right?
that's
So
correct.
when you are doing things, when you're investing in problems that you can't see, you got to really plan for the worst, right? It could be 2K or it could be 20K. So these are real red flags to us. And that also goes into, kind of buying also auction properties. Even though, in some scenarios, the whole home doesn't need rehab, when we buy auction properties, we're estimating that everything needs to be done. And of course, with good contractors and things like that, you can have people walk the exteriors, kind of get a good analysis to find indicators of these issues.
Yeah,
And
and
then,
for the majority, we try to stay away from foundation and flooding issues. They go hand in hand. What would be more open to us is fire damage. At least for fire damage, we can see the damage. We can see the work that it needs. Compared to foundation issues, it could be unknown. You're going into the unknown. So that's why we try to stay away from those.
yep. And fire damage, MD, give us a scenario of maybe some fire damage that we'd consider versus fire damages that are a complete no.
Yeah. So, of course, minor fire damage is doable. You can deal with the small kitchen fire damage. We can replace the drywall, we can replace the electrical, we can replace windows. But when it comes to major, for example, if the entire roof got on fire, then we have to change the whole rafters. The cost becomes more significant. So
Yeah.
we try to stay away from significant fire damage, but if it's minor fire damage, we can work with it.
Yep. And a good way to look at it, MD, I think we both agree that if it's damage to the cosmetics or surface level, it's something that we'd consider. But when it becomes to the point, like MD mentioned, a structural matter, I mean, it's almost the same as calling it a foundation issue.
Yeah, yeah. So that you want to stay away from. If it comes to the structure issue, you're like building a brand new house.
Yep. And we might as well build a brand new house at that point, right?
Yeah, yeah, yeah. Because the cost just gets way too high, and then at that point, the investment just doesn't make sense.
Absolutely.
So continuing on, how our final decisions are made. So we have an internal approval process. Aside from myself and Brother Nabil, we also have our project manager Mustaq Bhai. He does the construction managing and the project managing. He will give us the scope of work, the cost that we need. Not only that, he will look at certain issues and tell us whether to stay away from these red flags or whether these are minor issues and we can deal with them. Not only do we have that, we also have Shirley, our assistant, that also plays a pivotal role. She makes sure that our timelines are met in our offers, that our documents are sent out. So all of these are processed. Essentially, what happens is I will take in the property, I will evaluate it, I'll run the numbers, review it. If everything is good, I will send it over to Nabil. Nabil, he will evaluate it. He will get a green light from Mustaq by make sure it is good. And then we will send it off to Shirley. She will send the package over and make sure that our deal is finalized.
And it's super important that you do have that thorough construction evaluation, because this makes or breaks your deal. And when you know what the issues are of a property, that helps you with your negotiation. So as an example, because on a deal we just signed on it's a street on Teppert, they were originally asking $47,000. Because of the rehab estimate we got, because we were very confident in our numbers, we were able to tell them, look, our offer is 35,000. Either you take it or you don't. And the truth is, sometimes as investors, we often get a little bit more emotionally invested than we need to, right? It's just numbers. It's just money. All right. So, oh, I like how it looks. Oh, I really need to get a deal this month. When you have those kind of dynamics, you make rash or rush decisions. So know your numbers, understand your strategy, stick to your guns, and that's it. Submit the offer and see what happens. In this particular situation, MD, just tell us the back and forth of, from us sending that offer, $35,000, to how many times they try to counter. I mean, just kind of walk us through how that looked.
Yeah, so from the initial offer, we probably sent it 1 week ago, and it was just a verbal offer. It was nothing formal in writing, and we sent our offer, just in verbally to see what will happen. I believe they were, fishing for other offers and trying to get their best price, but essentially, it did not happen. They came back to us, uh, you know, nitpicking on the numbers, telling us, "Hey, we were asking for 48, it was 46,800, and then we will do 45." Then they came back at 42, and then they came back at 38, and then essentially we finalized at 35. So a lot of back and forth, but that's where I come in handy. Nabil doesn't have to deal with all of that.
Yes. MD is our expert negotiator. I tell him what it is, and that also helps, right? Because when he goes to the negotiation table, has a system and process to follow up. Or like, as an example, you ever go to a store, like let's take Walmart as an example. You want to do a return, and they say, oh, we got to talk to the manager, right? All it does, it adds additional layers of buffer and inconvenience for potentially the customer to maybe change their mind. about returning it or not. Oh, this is going to take 3 hours. I don't have time. I'll come back another day. Well, you come back another day and now your return policy expired. So sometimes when we have this system in place, it's there to protect us, to have checks and balance. But again, if we weren't confident on our numbers, MD might have said, it's just 3K in the bill. Let's go up to 38. But he knew that, what, this is our number. So we stuck by our guns. He did come back to me and he asked, hey, Nabil, what do you think? They're at 38. Do you want to consider going anything up? I said, no. And that's that, because you know what? The right deals will happen. We just got to know our system, our process. And you got to understand it's a numbers game. Sometimes you might look at 10, 15 deals before finding the right one. But one right deal, one good deal is better than doing 10 deals that are maybe profitable or can potentially make you lose money. So be patient, take your time, know your numbers, and stick to your guns.
You were right on the money when you said don't be emotional. Look at the numbers, because anybody can like a property. It's easy for that,
Yeah.
but when it comes to the numbers, you have to be very strict.
Yep.
So continuing on, this is the timeline of what happens after we invest. After we get our deal closed, we will get quotes from our contractors. And, essentially we look for quality of work as well as, cost. We try to make a fair judgment where our quality of work is good and our cost stays relatively low. After we secure our contractor, we will have our permits and city inspections done. That way we know exactly what the property needs. Afterwards, the contractors will start the work, and they'll give us a time frame of how long it'll take and if there's any additional cost. Again, when we have buffers, we tell our contractors to have buffers as well to make sure that we're accounting for any unexpected issues. And then as we go on, we'll have our project manager will stop by. He'll progress the work that's going on in the property, make sure the timeline is flowing correctly and that things are being done in a timely manner. After the work is done, completion and handover. That means we will figure out which strategy is the best, whether we are renting or flipping the property, and we'll put it on the market, start getting marketing material ready, and start our process for resale.
Beautiful. All right. Anything else, MD? Was there any
I
other
think
stuff?
we have like one or two examples here. So this was like our previous deals that we did, very successful small deals that we did in Detroit here. McKay is one that was completely deteriorated. I mean, the inside was just torn down to the guts, and then we fully renovated it. And then Healy, it was just a vacant boarded up home, and again we fully renovated that one. We were able to lease for market value at 1,200, I believe, for that area, and then we were able to resell it for $80,000. So that one was a great one as well.
Absolutely. All right. I think that is pretty much kind of how we analyze deals. One thing I'd like to mention is that things change very often. So the strategy or, the exact types of calculations we're using now, it might change with rates going up or, market shifts or even construction costs of labor and material. So being up to date on what's going on in the world, super important. But yeah, that's pretty much it, guys. I truly hope you guys had something to learn, something of value from it. That's how we do our deals. We're also open to learning from you guys as well. Some of you guys might be even more seasoned than us, but having that team, that tribe, that relationship in the market, in the industry to kind of guide, help one another, it makes or breaks deals. So we have 3 more minutes time available. Any questions, guys? Doesn't have to be specific to the subject today.
Brother, I have one question. Can you hear me?
Yes, we can hear you. What's going on, brother?
The question is, we getting the deal? Like, what are your top three criteria for determining whether a deal is worth pursuing?
Top three, what criteria for what?
Whether a deal is worth it.
So, I mean, at the end of the day, it's simple things, right? Your rehab, your purchase price, and your ARV. For us, once we factor those three things in, the top three indicators are what is our return, what is our timeline, and what are the risks. And the risks could include timeline delays, complexities in the rehab, underestimating market shifts. It could be over analyzing or overestimating the ARV. But super important is the neighborhoods that we're investing in. But again, your ROI, your timeline, and your risks. Those are the three things we're focused on analyzing.
Yep, gotcha. Thanks, bro.
No problem. Any other questions, anyone?
Yes, Nabil, can you hear me?
Yes, assalamu alaikum, brother.
Walaikum salam. How are you?
Alhamdulillah. Thanks for joining us, brother.
No problem. Sorry, I was in the middle of the meeting. I don't know, this meeting is particular for the Fajr Fund or just an overall strategy you guys showing this, how you guys acquisition and how you guys invest?
So this exact strategy we showed is something that we're currently doing and will be exactly what we're implementing into our Fajr Fund investment. So basically
Gotcha.
what you see now is what you're investing into when you decide to partner with us.
Next question I do have is that where are you guys getting your properties from? Is it like a auctions or it is the private listing, off listings? What is your source of properties?
Yes.
That is
So
a great question.
go ahead, MD.
Let me share my
If you-
screen again.
Maybe I missed that part.
No worries.
It's
Yeah.
okay. I'll go back. That's fine. Let me replay it. So these are maybe you missed these initial slides, but these are where we find our properties. The MLS, which is that multiple listing services. This has essentially thousands of websites incorporated with it. It is the market. Any property that you see on the market, you will see. But also this gives us opportunity to find off-market properties where we can cold call sellers. We have a whole team dedicated to make calling successful, and we're able to connect to direct sellers this way. Another way we can get deals is wholesale opportunities. We deal with a lot of wholesalers that are able to find us lucrative deals, and these deals are usually distressed properties that may need a good amount of work, but again, they are a good and lucrative deal that can bring you a good amount of value. And essentially, the final one is property auctions. When we have time, we do attend property auctions. We're able to see property auctions online, as well as we're able to sometimes visit the court, and we're able to bid on them that way. Another way we can find these direct sellers is just door knocking. If we're in certain neighborhoods and we're already evaluating properties, sometimes neighbors will come talk to us, or sometimes we can just walk the block just to see how the neighborhood is, and we'll find people that we can connect to, and that's how we get deals as well.
Gotcha.
And
So just to understanding, what's your majority bulk coming from, like a MLS listing or the like a 60/40 is 40% is for the auctions? Because my concern was then if it is an auction and most of the time you guys are not having access to the inside, right? Accessing or evaluating the property is going to be much higher risk than the
yes.
listing, right?
That's
So what's your bulk of this coming from?
So
yeah, go ahead, Nabil.
yeah, so property auctions, you're absolutely right, which is why I said if we even consider those, we're assuming that it needs everything. And
Yeah.
if we happen to go there and find out, oh, hey, the floors are okay, we can keep those, then that's all just bonus. But yes, we have to evaluate for the absolute worst case scenario. Between these different ways right now, I would say 40% of our deals are coming from wholesale opportunities, 20% from MLS, 30% from cold call, and 10% from auctions and just random inbound leads or a unique situation, right? But I would say cold calling and wholesalers are predominantly the ways we find. The MLS is the third.
Gotcha. Then. Thank you.
Any other questions, gentlemen? All right. I think that is all the questions we have. We're a little over, but anyways, again, I appreciate all of your guys' time. Inshallah, even though we may not continue to do seminars or webinars for the next few weeks, our intention is that regardless with Fajr Fund launching and whatnot, we're going to continue to come do educational webinars like this because honestly, it's been very fun, enjoyable. I love meeting new people, and we've gotten a lot of good feedback on the information. So if there's any topics, anything that comes to mind, please text us, email us, whatever. We'd love to continue training you guys.
Before we get off, I do have a suggestion, Nabil. Let's go ahead and create a survey for everyone to see, exactly certain things that they may want to learn or include next time we do have a webinar.
Sounds like a good idea. We'll send an email out to everybody.
Beautiful. Perfect.
All right. Have a great day, guys. Bye-bye.
Thank you. Bye.
Take care. Bye.